India market. Very impressive and very happy to listen what their perspective is on NBFCs and MFIs. And then we have Mr. Ankur Srivastava, the managing partner. He is at Laws, IBC. He's presenting the IBC perspective. And then Sahil Narula, the partner RNC ValueCon, and he's speaking about IBC and valuation perspective. Then we have Mr. Anuj Kakkar, the co-founder of FIO, and he's speaking about the new banking perspective. I had a word with him in the morning, and I think we are going to enjoy the discussion. And then we have Mr. Mridul Gupta, who's the panelist digital, and he's from the Coin DCX, and he's speaking on digital currency perspective. So we have a complete spectrum of people giving their perspective today with us. So with that, I would now like to invite the first panelist for the day, and that is going to be, just give me a second, I think if it's okay, Mr. Devanji, his partner and national leader Financial Services EY. Mr. Devanji, you are giving us the banking perspective. Would you be leading I think we will really enjoy your presentation. So I would invite you to please share your thoughts with us.
Thank you, Charan Singh, and welcome everyone to this perspective around financial services and the way forward to the new economy. Now, as far as banking is concerned, I would include banking and NBFC, so any form of lending that happens within the services sector. Now, in financial services, we need a fair amount of innovation to happen. We are today 70% government sector banks, 30% private sector banks. And that ratio is changing very fast, with the private sector taking a much more larger leap. And within the private sector, the NBFC sector is around 8%. And more than the NBFC sector, a growing sector that's coming about is fintech-based lending. And we're going to face challenges across usage of technology to lend, across traditional PSU banking, across private sector banking. And need to make sure that between the three of these, we deliver the kind of finances that India needs to grow the economy to the way it has to. Now, what are the lacunas and what are the obvious issues that we face today? One is regulation needs to be less rigid. Today, almost everybody except for a bank has a arbitrage to deal, and they are dealing with arbitrage. And we, in the name of public deposits, are unable sometimes to give the kind of flexibility that a system needs to lend. And I will start with this large issue around infrastructure lending. For India to grow into a 5 trillion economy, we need a very significant push, a 70 to 80% increase in infra lending. And infra lending, by the way, since our crash of 2015, when credit got squeezed and ILFS happened, infrastructure lending has almost become taboo in this country. And unless we are able to finance build-outs of infrastructure, it's going to be very difficult for us to grow. Now, things are happening. So we've now set up a infrastructure bank, in the process of now building it out. Very good initiative, because if you look at the way banking grew in India, initially we had IFCI and we had IDBI and we had ICICI, and these were large-scale infrastructure lending institutions which had access to longer-term money, patient money in the form of bonds, and they deployed that in patient infrastructure capital, and that's how India built its temples of modern India. And they funded them very well. But over time, what happened is that the larger banks, commercial banks, PSU banks, the private sector banks that came about, they started investing in the infrastructure themselves and lending sector. In the process, what really happened is that the original infrastructure capable financial institutions turned into universal banks because they needed cheaper costs through the infrastructure bank, and I try to build that. But there will be a large challenge of figuring out how do we get the competitive financing being made available to the infra bank. and the way I would want it to happen, envisage it, is that the infra bank will build the capability to lend to infrastructure. Have a first loss absorption structure where they provide semi-equity structures. And the commercial banks then come and provide senior secured lending to it on the back of a guarantee or a first loss absorption from the infrastructure bank. Then we will find that more of our capabilities are coming together. So that much on infra. I have a few minutes to talk. I'll curtail that. Coming to inclusive banking, another large aspect of inclusive banking is what we have in terms of priority sector lending. 40% of our deposits have to be deployed in priority sector lending, and that's a requirement of the Reserve Bank of India. I need innovation in this. I do not think that a State Bank of India is capable of going and doing a 5 lakh lending to a marginal farmer in the middle of nowhere. Frankly, it's not their job, it's not their scale. But we now have an ecosystem of financial services companies. We have the large banks, we have the NBFCs, and we have the microfinance companies, we have the small finance banks. We have a good infrastructure now in place. And why did we not push priority sector lending to those companies? So in short, I'm saying SBI should do 40% of priority sector lending, but it should not lend directly. It should be allowed to issue priority sector certificates to the extent of 40% wholesale lending into the rest of the infrastructure, which is the microfinance companies, the small finance banks, and the NBFCs. And those NBFCs should be made to lend because they have the expertise to develop geographical areas where they can do better collections, they can do better lending, they know the community better, and hence we will find more and more inclusive banking happening at a localized level rather than a large centralized bank trying to do it with a localized operation. And that's why today we're struggling with how to deliver credit to agriculture. We're struggling how to deliver credit to SMEs. And unless we build that inclusive credit culture into our system, we'll find it very difficult. Coming on to the liability side, and I'm conscious of time, coming on to the liability side. On the liability side, we face large issues. Today, for example, bank interest pays almost nothing, and we have money gravitating to our stock exchanges. Where will the banks get the finances? The banks today have the finances because of a safe haven situation. What we're proving is that safe haven is not really as safe as we think it is. With the number of bank collapses that we've had in the country over the years, the number of banks which have been merged into other banks just as a saving grace. We need to strengthen that confidence level in our banking, that we have great underwriting and collection capabilities so that public money is secure. Not by doing write-offs, but by making sure we have an efficient recovery system. We have IBBI talking today, and I will. It's the topic closest to me, but I will talk about it. The fact that we need to have a very good resolution mechanism. IBC is a great mechanism, but beyond IBC is an enabler. It's a law, but we need specialist organizations. Bad bank is a good thought, but it has to be implemented really better than what it is implemented today. But if we can actually get a thinking going to say, let there be a bunch of specialists who will try and resolve assets. And the bank's job is to grow. Once an asset reaches a particular stage, they have to consolidate out and give it to an entity which is specialist in recovery on a timely basis. Maybe SMA2 accounts should just move there. And let them create an engine to recover. We are stuck in this accountability concept that the minute we sell it to a bad bank or a specialist entity, ARC it could be, a specialist entity, we are losing out responsibility. Yes, but what you have to measure then is what actually goes to that specialist entity rather than who ultimately resolves it. It's not the job of a bank to resolve it. The bank should identify that it has reached an SMA2 level and quickly move it out. And then the accountability on the bank should be as to what is moved out to a bad bank rather than what ultimate recoveries the bank can do, because we spend a lot of time in our banks and our banks don't have the capabilities, by the way, to be able to do recoveries on a consolidated basis. So again, I would like to summarize my conversation. My 9 minutes are nearly over. I think we need specialist banks which do infrastructure lending. We do need a lot of focus and a rethink around inclusive banking, and we need to step up our credibility mechanisms in terms of better collections rather than contracted lending. as far as safe havens of banks are concerned. Mr. Singh, back to you, sir.
Mr. Devanji, thank you for your initial observations. I think they're very good. Would you have a view on the Vision 2047 or a roadmap? You have mentioned basically two things as I captured. One is the need for infrastructure funding, and secondly, of course, the resolution mechanism. I totally agree with you. I also agree that initially we did have the investment banks in our country. IDBI was one of them, ICICI, you mentioned it, but over time they became universal banks. But I must also observe that State Bank of India, certainly for a very long time, was in infrastructure funding and infrastructure finance, even when IDBI and ICICI were there. When these two funding institutions did not or waned away, even then, State Bank of India and Punjab National Bank, Bank of Baroda to some extent, started filling in the gap. And then the other banks which did not have the capacity to evaluate a project of infrastructure level would then join the lead bank. So SBI would become the lead bank, and then there will be other banks who will join the team, and then pooled resources would reach. So to that extent, I would say I would dispel the fear as if there is a vacuum in infrastructure funding. That wasn't the case. But I totally concede your point that most of the commercial banks do not have the capability to assess the cash flow and evaluate the commercial viability of a big infrastructure project.
So my thinking was only that. If SBI is the only person which has today the capability of understanding cash flows better, and Infra Bank will obviously develop that skill itself, then they should be taking the first loss and not offering pari passu loans with the others. It should not be a case that somebody takes a paper from one bank and says, oh, because one bank is approved, I'll put my approval. It should be a structure where the bank which takes the onus of the responsibility takes the first loss. So the other banks are naturally protected because they are super senior.
Sure. I'm looking forward to the views of the former Deputy Governor and Ajit Pai, but I am of the view that in the next 25 years, banking is going to change to unrecognizable levels. And my own feeling is that infrastructure funding would probably play a bigger role through the stock markets, and banks will probably begin to take the back step in infrastructure funding, as is the global phenomena. Fintechs, of course, will play a very big role, but in infrastructure funding, as you would know, brick and mortar branches is not as much needed. And of course, with internet banking and Jam Trinity, banking is going to change its color and contours in the next 25 years. Let me move on to our next speaker, Dr. Sandeep Dadia. He is the CEO and Principal Officer at Aditya Birla Insurance Brokers, and he's giving us the insurance perspective. Dr. Dadia.
Thank you, Mr. Singh, and good afternoon, everyone. So I think one of the most disrupted industry is one of the most, insurance is going to be one of the most disrupted industry, where, we are actually seeing a lot of consumer behavior which is changing. And likewise, and to match those, the solution providers and the solutioning also is changing. So in fact, if you see the insurance as a sector, the capacity fluctuation across the market, and I'll just go a little brief into what I mean by capacity. So as all of you all know that every insurance company is reinsured with some reinsurance company to actually pass on their risk to the another company. Now with so many geopolitical situations, the capacities are shrinking. One fine day, we see China, Russia capacities are not available for India. Another day, all these capacities are flooded when the sanctions open up. Likewise. So what happens here is, suddenly there is an increase in the premium, suddenly there is a decrease in the premium. Extremely difficult to price a product based on, the long-term products will actually have a huge change when the reinsurance capacities are changing. If you also see overall in the sector, insurance companies are facing huge losses, and I think besides one or two or few of them, there are no insurance companies who are making underwriting profits. Most of them are actually coming from the investment incomes and otherwise. So that is going to make the situation more and more difficult for insurance company to be more profitable, because they also get the revenues and they also get their profits when they're placing the reinsurance. The uncertainty of the risk is also extremely high. Now, I mean, all of us know that pandemic was a risk which was not imagined by most of the players or 99% of the insurance buyers in the world. Now, what has happened to those buyers? Of course, they could not get the risk cover and they could not get the claims. But what happens to the insurance company? Even if they have insured a few, or if they those losses are catastrophic for them. If they have not been able to insure those clients, of course, the client is going to demand for these kind of covers. So this is going to push towards newer and newer risk covers in the market. We have seen in India, a lot of insurance companies started offering COVID covers. And suddenly after 6 months of huge losses, they started withdrawing the covers. So the risk profile is changing of the customer. The risk perception of the insurance company, that is the underwriter, is changing. I just spoke of the retail lines of business, that is the individual covers for COVID. Now just take a case of business interruption losses, which is for the entities or the businesses. So what happens to those? Currently, most of the clients, or I would say 99.9%, most of the clients are actually buying business interruption losses, which is after a material damage which takes place. There are very few people or buyers in the market who are actually buying non-damage business interruption. This is going a little technical, so I will not go beyond this. But what I'm only trying to say is business interruption is going to be a bigger concern for every entity when such kind of a black swan event happens. And you know, the quantum of the loss cannot be predicted here. And I'll tell you why it can't be predicted. I'll just give you a very simple example. When we are sitting inside a room and the neighboring room, we know what is going to be the asset of that room, and any damages, we are able to assess the quantum of damages. When we say an event like a pandemic or some kind of a war like a situation or a terrorist kind of an attack, where the businesses are disrupted or closed down for say months together, the losses can be catastrophic to the client as well as the insurance companies. So those kind of covers, people will start asking for. Insurance company will be shying away from giving an absolute covers, and there is going to be a crunch of capacity from the reinsurance world for these kind of buying in the market. I'll give you another example. I was just reading through an article. ESG is now a very strong phenomenon across the world. Now, many of the insurance companies or reinsurance companies across the globe, I'm not talking about Indian capacity, but reinsurance companies across the globe, they've stopped covering ESG. What happens to those plants, which are actually the coal, they're based on coal or something like a thermal power plant, and when they don't have those covers in the next 5 years, when an absolute ESG is mandated? I mean, God only knows how will we insure these kind of assets in the future. Of course, it gives a buying opportunity for the insurance sector. It gives a new opportunity opening up for an insurance sector to provide new capacities. But yes, this will definitely shrink the capacities in the market. When I'm talking about an individual line or an individual buying insurance, now the trend is moving towards smaller products, and we will see a time where people will be buying sachet products more. I mean, just to give you an example, all of us are actually well versed with the concept of health insurance. People have bought hospitalization covers. OPD will be in shape now. OPD will be one of the flavors of the market. In future, it has already started, but I think future is extremely bright when the OPD systems become robust, the infrastructure becomes robust, and they all become a connected ecosystem. Something like, individual risk-based covers. So when I'm talking about, say, only a pandemic cover, only a vector-borne disease cover, something like I'll just give you an example of a vector-borne disease cover, which means a mosquito bite cover, which causes a malaria or a dengue. Only a small insuring clauses will be covering these 2-3 illnesses only caused by mosquito bites. These are seasonal covers, but there will be a good demand for these kind of covers, because a person need not spend the entire health insurance amount and buying a 5 lakh cover is going to be an extremely expensive affair for anybody to buy. But when he buys a vector-borne disease cover, something like to do with a mosquito bite, they may be covering only costing only a few hundreds. So the new age forms of risk covers are evolving on the retail side. But let me tell you and assure you, fintechs and insurtechs are going to rule the world. they are going to definitely create a seamless and a buying experience. Now, if you see the buying pattern of a consumer, the consumer behavior has changed, the consumer psyche has changed, the consumer awareness is changing. Every consumer wants to compare and buy. Every consumer wants to actually buy a newer product. They have become insurance conscious. And of course, thanks to COVID, people have realized that, look, there is a need, urgent need for an insurance cover for a family. So, of course, one is the product will change, and of course, the buying pattern, the buying experience will change. If you see the journey from buying, which was purely physical, which has become digital, and I believe that it will become purely digital in some time. So the entire consumer pattern, and that's how the business model in the insurance sector also is going to change. And that's the reason I'm saying that fintech will rule the world, or an insurtech will rule the world in terms of the future of growth of the insurance sector. The platform economy, I mean, if you see initially, the insurance companies used to be traded at a multiple, and they had a huge market cap. We've seen in India with a broker being listed where the market cap of the broker is higher than the insurance companies. We see globally, the top 5 insurance brokers are now having market cap which is more than insurance companies, many of the insurance companies, and I would say most of them. Combined market cap I'm talking about of 5 insurers, but the largest one will be having more than 60, 70, 80 billion plus dollars of market cap. So that is the way the distribution is changing. The distribution patterns are changing. I am also extremely worried in future about the capacity fluctuation, which I just mentioned. What is available today as a risk cover may not be available next year, and what happens to the BCP, or what happens to the continuity of the risk covers. So this is going to change the way. Now, I'll just give you with an example for the people to understand. Insurance is a highly technical subject, so for all of you all to understand, I'll be quoting multiple examples. So just imagine cyber cover or a cyber risk cover, which people used to buy a few years back. Today, when one wants to buy just a small limit of 200-300 crores of sum insured, people are not able to get, and if they are getting, it's at a huge price. So that's the level, and of course, the number of attacks are increasing. The risk has changed completely. There are a lot of, and by the way, we ourselves have handled more than 6-7 claims in cyber threats and cyber ransom. And mind you, the ransom mails are so professional, I would say, in their own subject and in their own field. The payment also goes in bitcoins they are asking for. So that's the way the changes are happening, and the claims are being paid to these the customers. Also talking about the integrated or the closed loop ecosystems are going to evolve. Risk will change. Yeah.
Just be aware of the time.
Sure. I'm sorry about it.
Say a minute more maximum.
Yeah. Absolutely. Sorry, I get very passionate when I talk about insurance. So just to give you from motor, now just imagine when the electric vehicle comes, what happens to the insurance? Are we going to buy an insurance or an AMC? So, things will change in the insurance sector. But yes, to sum it up, the products are going to change. The consumer behavior is changing for sure. The buying pattern is changing. And insurtech platforms are definitely going to rule the world. So thank you, Mr. Singh, and thank you to the audience for the patient hearing.
So, Dr. Dadia, your view is that the insurance penetration will increase and the products would become now micro products. You would break it up into pieces. I like the example that you gave on a mosquito bite, and that would become around the monsoons. It will become that insurance will not be annual insurance, but then it brings in a cafeteria approach. You could probably have the flu. You could have the malaria, you could have other things which are then broken into pieces, and you could insure yourself for that. That, I think, was a very interesting idea. Thank you so much for your thoughts. And I was thinking, you are right, and you concluded very well that digital impact is also going to be massive. And with the young demographic India that we are, certainly the internet availability, that will make a very, very big difference. Yes. Thank you for that. Let's move on to now we have Shri Sadaf Sayyed. He's the CEO of Muthoot Microfin. I'm really excited to hear him, and look how they penetrated North India so effectively within such a short time. So over to you, and please requesting you to be mindful of the time.
Sir, Vishwanathan sir, Charan Singh sir, all the colleagues who are present here as co-panelists, and all the people who are listening, very good afternoon. I've been given a task to speak about how the future is going to pan out for NBFCs and MFIs. Rather big task and a lot of responsibility on me, but I think my panelists before have done a lot of hard work for me, and Charan Singh sir himself has spoken about how the economy is going to grow. So I basically represent some company which is working at the bottom of the pyramid. So we are a microfinance company really catering to the real bottom of the pyramid, lending only loans to SHG groups and JLG groups. So I bring that perspective with me. I think one of the things Charan Singh sir said that the economy needs to grow from 2.5 trillion to 5 trillion, and then by 2047 to 40 trillion. That is what the government of India is talking about, and that's the vision that we have. And in my opinion, growth in economy is also a function of credit growth, and credit growth plays a very, very important role in boosting the GDP. So I think we have seen that there was a recent NCAR study which shows that microfinance effort till now has been contributing around 2% of the GVA, and this is likely to go up to 3.5%. And the impact that it has created around 13 million jobs directly, and then obviously indirect impact in the economy. So it plays a great amount of role in terms of bringing people into the credit net and promoting financial inclusion. So I think financial inclusion we largely understand by way of like providing banking services or maybe credit, but in I think in normal parlance that is the understanding, but actually financial inclusion is a lot more wider. It is not only about opening a bank account, it is not only providing one loan, but it is also about providing alternative for savings, providing alternative for remittance services, providing financial literacy to the people. So I think we have to look at the holistic basket, and there is some great amount of work that is happening in Indian economy. I think we are by far most rapidly growing in terms of digital format. I think NPCI numbers are startling. I think in February itself, they have done some 4.5 billion transactions digitally, and around 8.27 trillion rupees have been transacted through that. So I think it's one of the best platform that has been created across the world. And I think the things that has happened over the last few years, like 5-7 years, are very, very great kind of a positive moment. So Charan Singh sir talked about Jam Trinity. So in our case, I think the Jam Trinity, Jandan, Aadhaar, and mobile has really, really helped us. There was a time when most of the microfinance business was done in the cash format. All the loans were given to the customers into cash, and the collection was done in cash. But now I think the things have evolved so far that almost 100% of the disbursement is happening into the bank account of a customer, which goes to prove that people at the bottom of the pyramid are having a bank account, which is a functional bank account. So I think that was achieved by a great kind of visionary step that Prime Minister Modi took in terms of opening Jandan account for all people, and that has really kind of kick-started the direct benefit transfer and whatever transaction that are happening, and remittance, and in terms of any benefit that has to be passed on to the rural household is going into the bank account. So that banking habit is getting developed. So that has been a great, and then the Aadhaar infrastructure that we have created and penetration of mobile has really made our job easier in terms of identifying customer and underwriting customer. Some great amount of work has been happening in fintech space also in terms of understanding the behavior of the customer. Over the period of last decade, prior to, I think we all know there are credit bureaus, but largely the credit bureau which were there earlier were catering to the consumer loans and large ticket loans, but there were very few credit bureaus, or there were no credit bureaus who were looking at the bottom of the pyramid. But with the effort of industry SROs, which is in microfinance, so we have developed two credit bureaus which are very active, Equifax and Highmark, now known as CREF. They have database of all the credit borrowers who are really at the bottom of the pyramid, all the JLG groups. So we have a credit profile now of these customers. The data is very rich now. Even during the pandemic, we were getting a good amount of information, and the proof of the concept is that despite all the pandemic and all these issues that we have faced, where the collection fell almost as low as 50% is now back to around 96% on time. So which shows that the bottom of the pyramid customer is really credit worthy. So I think the infrastructure is in place, and a lot of innovation is happening. NPCI is doing great job. Just recently, RBI announced along with NPCI, they have developed 123 Pay, which is like a payment enabling system through feature phone, which is again kind of a great initiative to bridge the digital divide that we have today. So I think some great amount of innovation is happening, and we are taking credit to the bottom of the pyramid. I think more services are now reaching. Speaker before me was talking about insurance. Microfinance is also a vehicle of taking insurance to the bottom of the pyramid. A lot of these people are getting life insurance. Almost all our customers are covered for a life insurance, more like a credit shield product. There's health insurance also that is reaching this space. We ourselves have initiated